We're going to work through the Jensen cash flow worksheet example. If you pull up the Jensen worksheet, you'll notice that I've entered in the beginning balances. So what you're going to want to do is stop the tape and get caught up and by entering the ending balances for 2015. And these are just here in the check balance column. These are hard-coded numbers with subtotals. Also, before you move on, make sure that you review how the ending balance is arrived at by looking at the formulas. So just as a quick review, in the debit section, you're going to take beginning balance plus your debits minus your credits to get to ending. In the credit section, you're going to take your beginning balance plus your credits minus your debits to get to ending. So review those formulas and also type in the ending balance. When you do type in the ending balance, one account to be really cognizant of is the accounts receivable account, because we're going to record that at a net value. So if you look at the beginning balance, and if I pull up the information for the problem, the beginning balance was arrived at by taking the 130 minus the 8,000 to get to 122. So the ending balance for accounts receivable is going to be 135 by taking the ending balance minus the allowance for doubtful accounts. So the easiest and quickest, most efficient way to handle accounts receivable is to show it as a net number in the debit section. Otherwise, all the debits and the credits are divided up. One more reminder is that you won't have any negative balances in this worksheet. After you're caught up, the next step, how I usually approach these, is to look at the accounts that are pretty straightforward, that just have one offset down below in the cash flow section. So for example, your cash has a simple offset. Accounts receivable has a simple offset. Your current assets will. Your current liabilities will have a offset, with the exception of dividends payable, which we do not have in this problem. That one's a little more complicated. We'll see that in the Western example. Then we can look for anything in the problem that is not a non-cash item and doesn't have both inflows and outflows. So we'll hold off on common stock and land because that's a non-cash exchange. Common stock was issued and exchanged for land. We'll hold off on equipment and investments for now because those both had sales. Otherwise, long-term notes payable is not listed, so that is going to be a simple offset down in financing. And I'm also going to flag retained earnings because even though that has two items in it, it's usually not too difficult to compute. So now we're going to simply just plug in the numbers that will make our ending balances equal to our ending balance will equal the check balance. So cash has the offset down below. And I'm also, while I'm here, I'm going to flag my totals with a different color just to make sure that I'm constantly checking to make sure that I'm in balance. So checking this as you go will save you a lot of headache because you'll find that you'll catch a mistake earlier than later on. Let's see, accounts receivable is next. To make this balance, I need 13,000. That will make this balance. And accounts receivable will be down in the operating section as an adjustment to net income. Inventory, we need a $14,000 debit to make this balance. The offset will be down in operating. For accounts payable, we're going to need a $10,000 credit to make these balance, and my offset will be down in operating again. income taxes payable is next, and I need a $2,000 credit. Offset is going to be down in operating. Long-term notes payable went down, so I'm going to need an $8,000 debit. And long-term notes payable is in financing. And for retained earnings, I'm going to look back at the problem, and I'm given net income is $67,000. So we know net income is a credit to retained earnings. And I can see I'm not in balance, so there must be some dividends. So let's see what it talks about for dividends. Cash dividends were declared and paid during the year. It's in the additional data, point 2. It doesn't give us the amount of dividends, so we can just plug for that number. So we want the number in here that will make this balance. And if I do the math, you'll need $74,000 to make that balance. So we'll bring both of these numbers down. Net income will go into the operating section. And we will have dividends down in the financing section. Okay, to make these color-coded, I'm going to label all these as yellow, basically the first stage of me working through the cash flow worksheet. All right, let's look next at the sale of equipment. So if I go back to the data of the problem, we've got equipment that cost $10,000, was 40% depreciated, and it was sold in 2015. So we know the original cost was $10,000 and there was 40% depreciation, so that means $4,000 of accumulated depreciation existed at the time of sale. And then if I look at the income statement, I'll see that's listed a loss on sale of equipment of $3,000. So let's look at those three pieces of information as we put together our worksheet off on the side. So we know we're going to take selling price minus your book value will give you a gain or loss. Okay, the loss was given as $3,000. The book value is going to be the original cost of $10,000 minus the accumulated depreciation of $4,000. So if we think about this, we would have lost $3,000 on something that was on our books for $6,000. That indicates that I would have had a sale of only $3,000, a selling price of only $3,000. So I took in $3,000, the cost was $6,000, and so I had a loss of $3,000. So now we can take this information and enter it into our worksheet. Starting at the top, the selling price is going to be included in the investing section. So selling price of the equipment will be an addition of $3,000 in investing. Then we'll include the book value in our worksheet. First, we'll credit equipment for the original cost of $10,000. Next, I'll debit accumulated depreciation for the $4,000 of accumulated depreciation on that equipment. Lastly, I will include the loss of $3,000 as an addition to the operating section. And I'll double check that I am in balance. So this schedule is very useful in making sure that we've accounted for all of the effects on the cash flow statement. So the sale again is at 3, the book value is the 10 minus the 4, and then the loss of 3 are all included. And again, we're still in balance after this entry. Next, let's look at the sale of investments. So we had a sale of investments. They originally cost us $35,000 and they were sold during the year. So we had a gain actually on this sale, a gain of $15,000. So we'll do another worksheet off on the side, listing a gain of $15,000 and a book value. The cost was $35,000, which means that we must have sold it for $50,000 because $50,000 minus 35 would get me $15,000. So I'll have sale of equipment or sale of investments in investing as a plus. And we'll use a different color. I'll have the book value, sale of investments up here for $35,000. And then I'll account for the gain in the operating section, so gain on sale of investments. The gain will be a subtraction because it inflated the net income and we need to back it out. And I double checked I'm still in balance. So there are the 3 parts for that particular entry. Let's see if it mentions anything about purchases. Okay, so nothing is mentioned except for land about purchases. So we'll just have to assume that these were cash purchases to make us balance. So looking at equipment, we can see that we must have had a purchase because when we entered the 10, we weren't in balance. And so we can plug a $32,000 difference here to make this balance. In other words, 48 plus 32 minus 10 will give me the 70 that I'm looking for. So we must have had a cash purchase for equipment of $32,000, which would go into investing. In investments, we must have had a $5,000 purchase because that will get us in balance. And the $5,000 offset would be down in investing. Okay, I'm going to just start reviewing my balances. So building had no change, so we have the land yet to look at. That's not in balance. We have the accumulated depreciation. Now we can tackle this one pretty easily. Sometimes the problem will let you know what the depreciation expense is that would go into this slot, but sometimes you would just have to compute that. Okay, so there is depreciation, but the balance isn't given. So what we're going to do is just plug for the credit to accumulated depreciation, which would be your depreciation expense. So the difference here is 11,000. So if I put 11,000 in this spot, this comes out even. And I must need about $9,000 in here to make these equal. So I'm going to do my depreciation in one entry. So the 11 plus the 9 will be my depreciation expense of 20,000. So I'm going to add that down to operating. So I'm going to use both the 11 and the 9 to get me to 20. Okay, so those balance out, leaving common stock and land, which is our non-cash item. So going back to the data for the problem, it says that common stock was issued in exchange for land. And so this is an indication that there was a non-cash exchange in this problem. So common stock wasn't sold for cash, all of it at least. Part of it was exchanged for land. So let's just look at the changes in those two accounts. So land increased by 15,000. So we're going to need to get these to balance up on top. So I know that I'm going to need a 15 here. So land increased by 15. Common stock, what I'm going to need here is a $50,000 difference. Okay, so that gets you to 310. So the first step is to get these to balance. So we had a 15 and a 50. If the problem didn't say anything about a non-cash exchange, you would have two drop downs. You'd have land down in investing as an offset, as a credit, and you'd have $50,000 down in financing for the stock piece. So you would just bring those two down independently. But with the non-cash exchange, that means that some of these, there was some offset up here that was non-cash. So the land, we didn't receive any cash for the land. We received 15 in stock. So the 15 is going to offset 15 out of this common stock piece. So really the only cash that we received is the difference. 50,000 minus the land would be 35,000 in cash. So I only want to bring down the cash piece. So I'm going to go down to the financing section and include issuance of common stock for 35,000. That would be a debit, which puts me in balance. Okay, so just to review that one more time, instead of bringing down a $15,000 offset to investing and a $50,000 offset to financing, because there was some offset between those two items, I'm only going to bring the difference down as cash. So 35,000 was the only cash piece for that transaction. Not the 50. I only received 35,000 in cash. So at this point, my worksheet's in balance at 384,000 on each side. I scan my balances here, and let's see this. Let's double check my formula here. Okay, so these balance out here. All of these balance out. So I've accounted for all of the changes on the balance sheet. And then your last step is to make sure that you feel like you've got all of these items in the right section. So the operating, you should have your current assets, your current liabilities, your net income, and your non-cash items that affect your income statement, like depreciation and gains and losses. Investing should have changes generally in long-term assets, so we've got equipment investments, pluses and minuses. And lastly, in your financing section, you should have any kind of notes or bonds, things like that would be here, dividends, and your equity transactions. All of these items here will be added to your cash flow statement. All of these items will be subtracted from your cash flow statement, in your cash flow statement. So your next step would be to take all of these amounts and just put them into this formal statement, and you would have, more of a formal order. Usually your operating would start with net income, and then your non-cash items, and then your current assets and your current liabilities. So you would just bring these items over, you would add these, subtract these in the operating section. In the investing section, you would add these, subtract these. In financing, you would add these and subtract these. You'd finally include the balance to show that you've accounted for your change in cash. And then don't forget to add the non-cash section where you would simply list any exchange that was included in your problem. So here we had an issuance of common stock for land for $15,000. That's an important part to add to your cash flow statement.